Trendline breakout looks perfect, but traders still lose. Let me show you the hidden trap. Retail traders like you and me often draw trend lines on the chart while as soon as the market breaks that trend line in any direction, we immediately enter a trade in the direction of the breakout. But after some time, the price reverses and hits our stop loss. Now the question is, we did not draw the trend line incorrectly, and our entry was also not wrong. Yet why do we still suffer losses so often? To understand this, we need to know the psychology behind the formation of a trend line. Only then can we avoid falling into these traps. So in today's video, we will understand how to correctly draw a trend line on a chart and what psychology lies behind it. We will also look at some important trading tips. How to draw a trend line. First, let's understand how to draw a trend line. Suppose you have a chart where the price is making higher lows and moving upward. This means the market is in an uptrend. To visualize this clearly, if we connect all the higher lows with a line, we will see a line moving upward. This confirms the uptrend in the market. However, many traders get confused about one thing. Should we draw the trend line using the candle bodies or by connecting the candle wicks? The answer is simple. When drawing a trend line, you should try to touch the maximum number of points. For example, if we connect only the wicks, the trend line may touch only 2 points. But if we connect the candle bodies, the trend line may connect 3 points. So does that mean we should always connect the candle bodies instead of wicks? The answer is no. Higher time frame versus lower time frame. If you analyze the chart on a higher time frame and take entries on a lower time frame, then you must consider candle wicks. This is because higher time frames often have larger candle wicks compared to lower time frames. For example, on a 15-minute chart, if you draw the trend line using only the candle bodies, ignoring the wicks, it might look fine. But when you switch to a 3-minute chart, the price may appear to break the trend line twice, giving a false breakout signal. This often leads traders to enter wrong trades and take losses. Therefore, if you analyze on a higher time frame and trade on a lower time frame, include candle wicks. If you analyze and trade on the same lower time frame, you can use candle bodies. The same principle also applies in a downtrend. Why trend line breakouts trap traders? Now let's understand why traders get trapped during trend line breakouts. This example is from the Nifty 50 chart on March 28 on the 5-minute time frame. Here the price breaks the previous swing high, but instead of moving upward, it starts moving downward and tries to form support near the previous swing high. If we connect the higher lows, we get a trend line support where the market repeatedly tries to move upward. But suddenly, a large red candle breaks the trend line and support downward. Seeing this, many retail traders enter short trades and make profits initially. But traders who are waiting for a long position from support don't get the opportunity. Another trend line appears. After the price moves down, it again starts moving upward. Traders draw another trend line, and there is also a round number support at 23,500. Then a big bearish candle breaks the trend line again. Traders who missed the first breakout now enter short trades immediately, placing stop losses above the candle high. Smart money concept, liquidity. But if you analyze the chart using smart money concepts, you will see something different. There's more liquidity above the price than below. At several points, short sellers' stop losses are still present above. This creates large liquidity zones. The market always needs liquidity to move from one level to another. And the market usually moves toward the area where more liquidity exists. Before grabbing that liquidity, the market creates inducements or fake breakouts. How the market traps traders. First, the price breaks the previous high with a strong bullish candle, encouraging traders to enter long positions. Then the market reverses and hits their stop losses. Later, it creates the illusion of support, attracting buyers again and trapping them. After trapping buyers, the market now targets short sellers. It creates another strong bearish breakout candle, encouraging traders to enter short trades. Retail traders who missed earlier entries quickly jump into the trade. But after going slightly down, the market reverses sharply upward, hitting all the short sellers' stop losses and grabbing liquidity. Key trading lesson. Whenever you see a trendline breakout, always check. Is there liquidity ahead of the breakout? Because many times the market creates fake breakouts to trap traders. Another important point. If the price moves very quickly toward a trend line and breaks it immediately, you should avoid entering a trade in the breakout direction. Why? Because traders who entered earlier may book profits near the trend line, reducing the market's momentum and causing a reversal. But if the price consolidates near the trend line and then breaks out with sustained movement, you can enter a trade with a small stop loss. Using RSI to avoid fake breakouts. You can also use the RSI indicator near trend lines. For example, if the price keeps falling, but the RSI starts rising, it indicates a bullish divergence. If a breakout happens during this situation, there is a high probability that the breakout is fake.